Welcome to this presentation by Facilitators Research. This research is distributed exclusively for informational and educational purposes and does not constitute financial, legal, tax, or investment advice. For such services, you may reach out to speak to one of our officers.
Lesotho, a small open economy pegged to the rand, exposed to commodity cycles, climate shocks, and global rate moves. For over 2 decades, its interest rates and inflation have shaped the risk landscape for every financial institution. This is the insurance company's view. 5 periods. 5 sets of decisions. How should a chief risk officer have calibrated the risk appetite for life, property, health, motor, and agriculture coverage in each window? 23 years of monthly data from the Central Bank of Lesotho and the Bureau of Statistics. 11 interest rate series. CPI inflation. All numeric, all verified at source. For an insurer, the real interest rate drives investment yield on reserves. Inflation drives claims severity. Together, they define the underwriting environment. The framework for an insurance CRO. 3 forces shape risk appetite. Interest rates set the investment yield on the reserve portfolio. Inflation sets the claims severity trend. The real rate, nominal minus inflation, sets the solvency margin. When the real rate is high, the insurer can underwrite aggressively, because reserves compound faster than claims. When it is low, the insurer must contract. Period 1. 2002 to 2006. The policy rate fell from 16 to 11%. Inflation rose from 3 to 6. The real rate averaged 7.5%, peaking at 9.6 in 2005. For an insurer, this was a golden underwriting era. Investment yields on government bonds exceeded claims inflation by a wide margin. Reserve portfolios compounded rapidly. Solvency strengthened every year. With a 7.5% real rate, the CRO opens every line. Life insurance, expand. Long-duration liabilities are well covered by high-yield bonds. Property and casualty, expand. Real rate cushion absorbs claims volatility. Health, expand. Motor, expand. Agriculture, selective. Drought risk remains, but yield cushion covers it. Annuities, expand. The spread between bond yields and guaranteed rates is at its widest. Period 2. 2007 to 2011. The global financial crisis. Inflation spiked to 10.7% in 2008, then collapsed. The policy rate fell from 13 to 9%. The real rate compressed to 4.3%. Volatility was extreme. For an insurer, claim severity spiked with food and fuel inflation, then eased. Investment portfolios took mark-to-market losses on long bonds before recovering. With real rates compressing and inflation volatile, the CRO tightens. Life insurance, hold. Duration mismatch risk rises. Property and casualty, hold. Claims severity uncertain. Health, contract. Medical inflation outpaces general inflation. Motor, hold. Agriculture, contract. Drought and food price volatility spike. Annuities, contract. Guaranteed rates look rich against falling bond yields. Capital preservation dominates. Period 3. 2012 to 2016. Rates stabilized around 10%. Inflation drifted from 6 to 3, then back to 6. The real rate recovered to 4.7%. Stability returned. For an insurer, this was a predictable underwriting window. Claims severity tracked inflation moderately. Investment yields stabilized. The CRO could plan with confidence and rebuild lines that were contracted during the crisis. With stability and a 4.7% real rate, the CRO reopens selectively. Life insurance, expand. Stable yields support long-duration liabilities. Property and casualty, expand. Predictable claims environment. Period 4. 2017 to 2021. The policy rate hit its all-time low of 7.2% in 2020. Inflation rose modestly from 5 to 6. The real rate compressed to 2%, then turned negative for 32 months starting May 2020. For an insurer, this was the most dangerous window. Investment yields collapsed below claims inflation. Reserve portfolios lost real value. Solvency margins eroded silently. With negative real rates, the CRO contracts aggressively. Life insurance, contract. Long-duration liabilities unmatched. Property and casualty, contract. Reserve erosion severe. Health, contract sharply. Medical inflation exceeds yield. Motor, hold. Short tail, less exposed. Agriculture, contract. Climate and inflation dual shock. Annuities, contract hard. Guaranteed rates unsustainable. Defensive posture across the board. Period 5. 2022 to 2024. Inflation peaked at 8.3%, then fell to 6%. The policy rate rose from 10 to 11. The real rate recovered to 4.8%. For an insurer, the window normalized. Investment yields rebounded above claims inflation. Reserve portfolios recovered real value. Solvency margins rebuilt. The CRO who survived the COVID era could now re-extend. With real rates back above 4%, the CRO re-extends. Life insurance, expand. Yield recovery supports duration. Property and casualty, expand. Solvency restored. Health, selective. Medical inflation still elevated but manageable. Motor, expand. Volume returns. Agriculture, selective. Climate risk monitored closely. Annuities, expand. Spread between bonds and guaranteed rates reopens. This heat map shows every year from 2002 to 2024. The top row is the policy rate. The middle row is inflation. The bottom row is the real rate. Green means the real rate is high, favoring aggressive underwriting. Red means it is low or negative, forcing contraction. The pattern is clear. Lesotho offered positive real rates almost every year. The exception was the COVID window, 2020 to 2022. That was the signal to contract hard. 5 periods. 5 sets of risk decisions. The data tells the story. The CRO who tracked the real rate, calibrated duration, rotated between expansion and contraction, and preserved capital through the COVID compression would have kept the company solvent and profitable across the full 23-year cycle. The evidence is in the numbers. The framework is in the real rate. The decision is yours.